Randeep, great to have you today on ET Now. Thank you so much for your time. Wanted to understand firstly about your top line growth because that's only at a 5%, while your FY27 growth guidance stands at 20%. Tell me what led to the slower execution and is your guidance still achievable? And if so, how is it that you're planning to bridge the gap?
Ma'am, we had very clear guidance of 22% going forward in this year, growth over last year. And we still maintain that guidance. There has been a slow start to this because of, as I had mentioned last time in an interview, that we have new project startup happening. And of course, we had disruption in the global supply chain and India supply chain uh, let's say, backward supply chain requirements. So our manufacturing took a hit, and therefore some towers and production items got delayed. You know how it is in terms of the diesel escalation. So basically, this is something we are catching up in Q2 and Q3. So we are very comfortable and confident that we'll meet the 20% guidance. It's just a starting first quarter, and we will make it up.
Okay, and do you see some of those headwinds, Mr. Narang, start to fade, or despite those headwinds, you're still very confident of the delivery in Q2, Q3?
Yes, now we are confident because whatever the startup issues were when we had this disruption has been streamlined to a great extent. And we are catching up on the delays which happened in Q1. So we are confident that Q2 and Q3 will be much better in terms of our revenue numbers.
Okay, and talk to us about raw material costs and the pass-through element. How does it work for you in your business? Are you able to pretty much pass through all RM price increases to your customers? Is that built into the contracts and the orders that you win?
So we have around 30 to 35% pass-through. And the balance, when we bid, we look at what is the likely cost escalation and we then add it to our cost structure. So we are comfortable that the pass-through and the build-up on the cost, what we call firming up, will help us to maintain and improve our margins going forward.
Right. What I wanted to also understand was about your current order book, and how much of that exactly is going to be executed within this year itself.
So out of let's say 16,000 odd crores, 15,635 we have in hand, 400 is L1. So as we said, 20% guidance over 7,000 odd crores will be what we will do. And of course, we're looking at booking another 9 to 10,000 crores of new orders, out of which 1,000 is in the bag. We have already bid for 20,000 crores of new orders, likely orders in the Q1, which results will come in Q2. So we are very comfortable that our order book by end of the year, after the revenue execution, will be at least 2 to 2.2 times our revenue plans for the following year.
And Mr. Narang, your strength in terms of cash flow from operations in the full year FY26, right? I mean, that was visible. And
Yes.
this is despite the growth that you clocked. Does that
Yes.
continue going forward as well?
It will continue in Q2, Q3. Q1 has been a little slow. There were several payment delays by clients. Everybody was in a disruption mode. So that is going to happen. And we will look at definitely improving our cash flow and net working capital days in the end of the year.
And if I could get a sense on the order book growth as well as the opportunity size, just throw some color on whether pricing is holding up for you, whether demand traction is holding up for you, at least on both of those levers, which are important and critical for order book growth.
So actually demand is very good. The potential is amazing. We're talking about 5.5 lakh crores of new orders coming into India by 2030. We're looking at 1 lakh crores of orders opportunity for us amongst the various verticals in India. Another 50 to 60,000 crores internationally. So the potential is good. Now, how do we pick and choose the right orders with the right margin is where we play. And our teams are extensively working domestically and internationally on the localization, understanding the cost impact, And we are very well geared to look at an order intake plan of 10,000 odd crores. We are confident of that. And for me, what is more important, and for Transrail, what is more important is that our engineering design and the overall team which is there is amazingly good. It's very good. So our engineering led order intake plan is very much in place.
And last off, with regard to the order inflows, when I'm seeing the Q1 order inflows, you've got now a predominant chunk coming from international. Is that sustaining? Is it Middle East driven? Would a disruption there likely derail the kind of growth that you're seeing? Could you give us some color on that?
That's a good question. So this is basically the time lag between an order you bid and the orders when they are awarded. So at this point, Q1 was more international, but we look at a balance of 50-50. Out of this 10 odd thousand crores, it will be a balance of 50-50 order opportunity between international and domestic.
Right, understood. Okay, Mr. Narang, great to have you today on ET Now. Thank you so much for your time.
Thank you for having me over. It's a pleasure to be with you guys. Thank you.
Okay, on that note, let's take a very quick break. When we come back, lots more on the markets and, of course, buzzing stocks.